Hey, what's up everybody? Paul Fadiga here, and today we're going to be talking about shorting crypto. So I'm going to be demoing Apricot Finance over here, which is my current favorite borrowing and lending platform, and it's on Solana. So Solana is the best layer 1 blockchain right now because it's the fastest, it's the cheapest, and it has like a lot of liquidity. Not as much liquidity as Ethereum, but it's catching up. Also, like, I really like their developer ecosystem in terms of like the number of projects and the number of developers just building on their system. Like, their trajectory is like going up pretty high, and I think Solana will be the #1 blockchain for the next year or two. Eventually it'll get replaced by some other blockchains, probably some other blockchains that I've been watching that are in the pipeline that you guys probably haven't even heard of yet, but that's a topic for another video right now. But anyway, if you want to buy and sell crypto on using DeFi rather than a centralized exchange, Solana is the place to be. Before we talk about shorting crypto, I just want to talk a little bit about like the macro environment that we're in right now. In March 2020, the government decided to put everyone in lockdown because they're COVID. It ended up being a terrible idea. It totally didn't work at all. Essentially, everyone was forced to stop going to work, and then they didn't have any jobs, so they didn't have any income. So the federal government was like, well, we're just going to pay them to sit at home for a while. But we don't have any money to do that, so we're going to borrow the money. So they're going to go to the bond market and borrow the money. But the bond market doesn't have trillions of dollars in capital just sitting around just to loan to the government on the drop of a hat. So the Federal Reserve bought those bonds. So the Federal Reserve printed up a bunch of money. They introduced literally trillions of dollars into the ecosystem, right? Federal Reserve prints trillions of dollars, loans it to the federal government. The federal government gives it away to people. You know, so like there was like your bonus unemployment checks. It was like $600 extra a week. There was the stimulus checks. Maybe you got like a $1,400 stimulus check, $600 stimulus check. I didn't get any stimulus checks, but then there was the small business loans where they would loan money that you didn't have to repay to small businesses to keep people on their payroll. But anyway, so they injected trillions of new cash into the economy. So that's going to cause inflation. But fortunately, what happened, at least initially, was that everyone was locked in their houses. They weren't doing anything, right? They weren't traveling. They weren't buying things. So instead of them spending all that money buying like food and energy and things like that, they started buying investments. So they started buying real estate. They started buying stocks, eventually crypto. So the prices of all those went up. That was like in 2020. That was all skyrocketed. 2021 crypto prices skyrocketed because it was the same bubble effect with all the extra new wave of new investment money coming in. But then the economy started opening up, and then people were like, hey, I actually want to spend my money on actual things. So then people started like stop saving and start spending. There's only so many things to buy, right? So when a tidal wave of cash comes in to buy things, the price of them goes up. So the price of energy has been going up, the price of food has been going up. Just like basic necessities all around the world. And the price of stocks were getting boosted by this inflation wave and went woo up like this. And then when people are moving their money, whoop, right back down again. So what you're seeing right now is a corrective step where assets are going to come back down to like their true levels, right? You're going to see a crash in real estate. You're going to see a crash in stocks. And we've been seeing a pretty big crash in crypto. But anyway, I've been shorting crypto since January, and obviously it's been a shit show since then. Bitcoin, looking at the chart, peaked in November around 65K, had its first big drop off, went from around 50K right back down to around 37, 38K, stabilized around 40. Then there was the next big drop in May. So right at the beginning of May, we dropped from 40K down to 30K. And this crash right here was what killed Terra. So Terra was not able to survive this bear market because like it was fundamentally unsound to begin with. They had a really stupid stablecoin idea. I can't believe like intelligent people poured billions of dollars into that stupid idea. Went down to around 30K, and then we had another crash in June. So the June crash took Bitcoin down from about 30K down to around 20K. So right now Bitcoin's sitting at about 21K. It's on the higher end of its trading range. So now's a good time to start shorting again. Macroeconomic wise, I'm hoping that everyone learned their lesson from this. Like when the next time there's a politician who's promising to give you free things, I'm hoping that you will ask them where they're getting the money to pay for the free things from. Because the government does not generate wealth. It just takes wealth from other locations, such as through taxation or through inflation. The government prefers borrowing and inflation because like it's more hidden and they can blame it on other things. I mean, taxation is very obvious. It's very upfront and honest. But like inflation is more like a hidden tax. So like that's why the federal government prefers it. even though it's honestly more harmful than taxation. But the next time a politician wants to promise to give you, free college, free healthcare, whatever they're coming up with, you got to ask them where the money is going to come from. Because the suffering that you guys are enduring right now, this huge like bubble in like asset prices and the huge crash, and then all the inflation that you guys are enduring, that was caused by poor monetary management on the part of the federal government. So I have very little confidence in our world leaders right now. I'm hoping that eventually we can replace them with more competent people, and more generally I'm hoping we can get rid of democracy and replace it with a system that actually works, and replace it with a sane government system, because democracy is just a failed governance mechanism. Like it's not working. Democracy is not just a failure in the United States. It's a failure pretty much anywhere it's been tried. In the European Union, the European Union is getting hit even harder than the United States is right now. But anyway, enough talking about other people. Let's get to the main point of this video. I'm sure you're wondering, you as the protagonist of reality, how can I profit from this? Well, I'm glad you asked, my friend. In fact, you can profit from bear markets, and I'm going to show you how. So how do you short crypto? Well, I was looking through a bunch of different ways to do it. One example was on KuCoin. So KuCoin.com, they're like a centralized crypto exchange, and they have inverse leveraged ETFs. So they have what they call BTC3S. So that means they're shorting Bitcoin and they're using 3x leverage. So what this is supposed to do is if you buy and hold one of these, what it's supposed to do is that every time the price of Bitcoin goes down, the price of this ETF will go up. I don't actually recommend using this at all, though, because these inverse ETFs, the way their price moves is very counterintuitive. And you can't really hold them over long periods of time because they have this decay function. These ETFs are meant to be traded against. They're not meant to be held for long periods of time. But so there's better ways to do this, okay? So I mentioned before how much I love Solana. So we're going to do this all the DeFi way, which is the right way to do it, right? We need to get rid of these stupid centralized exchanges. These centralized exchanges are dumb. We should be using DeFi. We should be using crypto the way it's meant to be used. So there's 5 borrowing and lending platforms that I looked at on Solana. So the most popular one is Solend. Solend has the most liquidity. It has 384 million right now, of which only 140 million has been borrowed. So when we go through all these protocols, these borrowing and lending protocols, one thing you're going to notice is that very few people are actually using leverage. Solend is only using up 36% of its available capital. So I actually don't really like Solend that much. Back when the big Terra Luna crash was happening in May, I was trying to put some money in here and their RPC nodes are fucking up. And like, honestly, it's a little scary when you're trying to like withdraw your money and like it's not letting you withdraw your money because of some like random error. So that was a little disconcerting. Also, they only give you 75% LTV. That's the loan to value ratio. We're going to get into that. I'm going to explain that all a little later. But they only give you 75%. We'd like to see that to be a little higher. And they segment their pools. So the reason why they do this is in case you're taking out a loan against a shitcoin. So if you're taking out a loan against a shitcoin and your shitcoin goes to zero like Terra did, in that case, you're exposing risk to other holders that you borrowed their money that they might not get paid back. I'll get into that a little more later, but that's why they segment their pools like this. You notice they have a bunch of them. Another one I looked at was Point Finance, which is pretty small. It's only got about 17 million, and it's only got like a couple tokens right here. I looked at Oxygen. So this was the original first borrowing and lending platform on Solana. Came out about a year ago now. So I don't really know what happened to Oxygen. I think they might have rugged or something because they haven't posted anything on Twitter in 2.5 months. And as you can see, they only have 72,000 in total value locked. Whereas back in April, they had $17 million locked into their protocol. So I'm not sure what happened to all that money. One thing I've noticed over the past 6 months is that a lot of liquidity has just disappeared from these DeFi protocols. So not only has the price crashed, but people have been withdrawing tons of money from these protocols. So like Solend, I remember a month ago, this was like 700 million was the total supply. I remember just a month ago, Apricot, they had like 44 million in like total supply. So people have just been withdrawing their money in mass from these protocols, which causes us a little bit of liquidity issues, as I'll talk about later, but we're still fine. We got plenty of liquidity to trade against. So first I'm going to explain how leverage shorting works so you can get kind of a mental model for understanding this. All of these borrowing and lending protocols that we'll be working with use what's called over-collateralized lending, and I'm going to explain that in a sec. So in order for you to borrow money, first you need to have money as collateral. So what you can do is start out by depositing a certain amount of money. In this example, we're going to deposit $1,000. So we're going to put $1,000 in, and that's going to be our collateral. And then we're going to borrow against that $1,000. So we have $1,000 in USDC deposited. We borrow. Remember that Solend has a loan to value ratio, LTV, of 75%. So that means we can borrow out up to 75% of our collateral. So we can borrow up to $750 against that collateral. And if the price of SOL is $37.50, as it is right now, then we can borrow 20 SOL. So you can calculate your loan to value ratio by taking the total amount of money that you have borrowed divided by the total amount of money you have deposited, and that is your loan to value ratio. And this can never exceed a certain percentage. So for Solend, they'll let you borrow out up to 75%. That's their max LTV. And then if your LTV reaches 85%, they'll liquidate you. So what a liquidation is it means that they will take all of your deposits and then sell them in order to repay back the money that you borrowed. And the liquidation threshold is always going to be less than 100%, because if they let it go above 100%, then you would owe more money than you have in money deposited. And then you would have an incentive just to walk away and just never repay them ever again. And then the people who loaned you money would take a loss. So this whole system is designed so that the people who are supplying you the money that you're borrowing are not going to take a loss. So for example, let's suppose we're holding this same position right here, and the price of Solana goes up from $37.50 up to $42.50. In that case, we'll owe $850, which against our $1,000 means that we've reached the 85% liquidation threshold and we'll get liquidated. So yeah, in this scenario, we'd get liquidated and we'd lose our $1,000 deposit. We'd still get to keep the 20 SOL that we borrowed, because we borrowed that, remember, and it's still sitting inside of our wallet. In this case, now it'll be worth $850. So it's not a total loss, but it's not what we want to do. So now let's get into how we can use this to short the prices of crypto and make a profit on them falling in price. So what we're going to do with that borrowed SOL is we're going to sell it for $750, which means we need to find a buyer first somehow. And we're going to deposit that $750 back in as collateral. So right now, because we have $17.50 deposited, we can borrow out 75% of that. 75% of $17.50 is $13.12, and then we have to subtract the $750 that we already borrowed. We're already using that in our borrow limit. So we have $562 of fresh money that we can borrow. So with that money, we can borrow out another 15 SOL, sell the 15 SOL for $562.50, then deposit it back. Now have 2,312 as collateral. And then we can keep repeating this loop infinitely, although the amount of money that we can borrow and deposit decreases exponentially as the number of times we repeat this loop. But this allows us to achieve what's called leverage. So I'm going to talk about leverage right now. So in this case, we have a total deposited amount of 2,312, and then we owe a total amount of money of 1,312. So you subtract the amount owed from the amount deposited, and that results in the net value of a position. So the net value of this position is $1,000, which is the original amount that we deposited, right? So we deposited $1,000 originally, and we still have $1,000 in value. Now, if you want to calculate the amount of leverage you have, what you do is you take the amount of money that you are owed up here and divide that by your net value, and that is your leverage. So in this example, we have 1.3x leverage. And what leverage is it allows you to accelerate your position. So either you're going to lose money faster or make money faster using leverage. The maximum amount of leverage that we can achieve is related to the maximum loan to value ratio, the maximum LTV we can achieve. That's calculated by 1/1 minus LTV. So in our case, in the example above, with an LTV of 75%, we can get leverage of up to 4x. So that's the max leverage that we can achieve. So now let's suppose the price of Solana goes from $37.50 down to $15. In that case, we owe 35 SOL, which is now only worth $525. We take our original deposit of $2,300. We purchase the SOL for the $525 and repay the SOL that we owed, and we have a net value of $1,787 for a total profit of $787. So we took our $1,000 and turned it into $1,700 thanks to the price of Solana crashing, and that's basically how you make money shorting it. Now let's talk about the opposite, our liquidation price. So let's suppose instead of the price of Solana going down, it goes up. It moves against our position. What we want to do is calculate our liquidation price. So we take our $2,300 that we have deposited. Remember, our liquidation threshold was 85%. So we take 85% of that, and then we owe 35 SOL. We divide that by 35, so we arrive at 56.16. So in the case of this position, we would get liquidated at $56.16. The more leverage that you take on, the lower this liquidation price will go down, right? So the current price is $37.50 right down here. And then our liquidation price is right up here. The more leverage you take on, the lower that liquidation price comes down closer to the current price. So in that case, even a small spike in the price of Solana would destroy your position. So maybe you're right and the price of Solana is here and it's going to go all the way down. Maybe you're right long term, but like if you have a small spike, you get liquidated and then it goes down, it doesn't matter anymore because your position was already closed out. You've already lost. Right? So you have to avoid these liquidations. The more leverage you're using, the more carefully you would have to watch your position. So if you're using lots of leverage, you want to keep an eye on your positions almost daily. And if your position is moving against you, you can deposit more money to keep yourself from being liquidated, or you can start paying back the asset that you borrowed to deleverage your position. Okay, so that's enough theory for now. So let's get into actually doing this in real life. So this is Apricot Finance right here. You can see this is the total amount of money I have deposited, and you can see the total amount of money that I have borrowed out. You can see right here I have $4,000 in USDC deposited, against which I borrowed about $2,400 in assets, which leaves me with a net position of about $2,000. Portfolio leverage is currently at 1.24. So one of Apricot's superpowers that I love is they call it in-app swap. I'm going to explain this in a minute, but before that, I'm going to show you how it works if you don't have an in-app swap. So if you used if you use Solana or Port Finance or any of these other services who don't have this feature, this is how you would have to do it. So first, let's suppose I want to short Bitcoin. So I'd go over to the lending tab over here, and I'd push borrow to let me borrow out up to $1,100 in Bitcoin. We're not going to borrow out that much. We're going to borrow out like $100 in Bitcoin. Now, it's not really clear where this Bitcoin that I'm borrowing is going to. Is it going into my borrowing and lending platform, or is it going into my wallet? But in this case, it goes into your wallet. Now, if I go open a wallet, you can see that I have 0.006 Bitcoin right here. All right, so I want to short this Bitcoin. So what I've got to do is I've got to sell it right away. So I'm going to go over to Orca. I'm going to trade my BTC into USDC, trade it for $129. So I'm going to go back to Apricot Finance. I'm going to go down to the USDC. I'm going to push deposit. I'm going to deposit all my USDC back. So now if you go back and look at my dashboard, you can see the amount of USDC I have deposited has gone up, and the amount of Bitcoin that I owe has gone up as well. So that's all a rather slow, cumbersome process. So now let me show you how it would work with the in-app swap. So let's suppose I want to short Ethereum. What I would do is I would swap ETH into USDC. This is kind of crazy. I can swap a max of 3.6 ETH into almost $5,000. Like, that's how much leverage I have available to me. We're not going to do anywhere near that much, but let's do 0.1 ETH. So you might be wondering, I don't have an ETH in my wallet, so how am I selling ETH into USDC? So what it's doing is it's taking my deposit right here. It's using that as collateral. It's borrowing Ethereum from that it has available to it in this borrowing and lending platform. Somebody else has deposited ETH into this platform, and it's borrowing that ETH, and then it's selling it. So it's going through Orca and it's selling ETH at a price of $13.42. And if you go look on CoinMarketCap, you can see that $13.48 is the current price of Ethereum. So it's a pretty good price, not like necessarily the best price, but it's still a pretty good price that we're getting right here. So we just push this swap button right here. Okay, let's keep an eye on this. So currently I owe 0.92 ETH and I have $4,500. So we're going to do this swap, and you're going to see how it changes. I now owe 1 ETH and I have $4,600. So I hope you can see how this in-app swap saves you a ton of time and just makes the entire process so much easier. So let's suppose I wanted to deleverage my portfolio. I could do the opposite. Let's suppose I wanted to swap $100 back into Ethereum. And you should see these balances change. So right now I owe 1.02 ETH, and now you can see it just went down to 0.95 because I repaid part of the loan that I owe. So you can just play this back and forth for whatever you want to be shorting. So let's talk about historical returns. So let's look at the price of Solana over the past year. So the price reached all the way up to around 230, back in November. So let's start with that. So let's suppose we deposited $1,000. We're using a leverage of 2x, and the price of Solana is $230. That allows us to borrow out 8.69 Sol, which we can then sell. Price of Solana then crashes down to around, let's say $100, which gives us a price of around $2,129. Now at this point, we could cash out and take our profits, our $1,100 profit, or we could double down. What I mean by doubling down is that we take our new higher net value to double down and bet more. All right, so we still have our original deposit of almost 3,000. We add another 3,389 to it. We have a total of about 6,300, against which we owe 4,258. Still, we remember we owe the original 8.69 Sol, then we owe another 33 Sol. Add those together, we owe about 42 Sol, which is about like $4,200 at the current price of 100. So this is how our new balance sheet looks. We have about 6,300 in deposits. Now, after the price of Sol crashed down to around 100, it crashed down to around about like 35, which is roughly where it is right now. But remember, you have to avoid these little spikes like this. So after crashing down to about $100, so the price of Sol shot up to around $130 in the beginning of April. So if we weren't careful, we could have got this position liquidated. And although it would have gone down from 130 back down to 35, we might not have seen any of those gains if we got liquidated before that. So that's one of the things that I was warning you guys against. Let's survive that 130 pump. The price of Sol now goes down again. In that case, our 4,250 Sol is now only worth 1,400, which gives our account now a net value of $4,200. So you can see how we turned $1,000 into $4,200 in a matter of about 6 months just by shorting the price of Solana. So that was about like a 4x return on a crashing market, so that's pretty good. So I'm using this as an example to show you how you can use leverage and shorting to profit even in a bear market. Just because it's in a bear market doesn't mean that you can't make money. Now I want to go back to Apricot Finance and talk about some more nuanced little things. So you'll notice in the borrowing and lending platform, for example, let's suppose I wanted to deposit Sol. So don't worry about these interest rates displayed right here too much. So it says you get 4.47, but what you actually want to look at is that when you deposit money into Apricot, you get 3%. You'll get 1.03 Sol back after about a year. The other APR that they add in is just their little bullshit like inflationary token. So they just have their own token that they add in here, and that confuses things a little bit. So borrowing Solana, let's see, it costs about 10% right here. So that means if I borrow 1 Sol after a year of holding a position, I owe 1.1 Sol, right? It's a 10% interest rate. So those interest rates are not priced in dollars, they're priced in the token that you borrow. And then they give you some little reward thing, which is in there, a little bullshit token that just makes it a little more confusing. So but you'll notice some things like, for example, Orca. If you want to borrow Orca, look at this interest rate, it's negative, and you might be like, how would that make sense? They're gonna pay me money to borrow Orca? But actually the interest rate is 4.3%. It's just the reward APY is higher at 6%. Just look at these numbers and don't worry about the reward APR. So like Apricot has its own token, and then they just reward you for using their platform in their own little incentivized token. So other interesting features that Apricot has is that they have an assistance system. So if you're getting too close to your liquidation threshold, let's say the safe borrow limit's 90%, they'll trigger this assist bot right here. And what this assist bot will do is it'll start selling off some of your assets for you and then repaying your loans so that you can get yourself down to like a safer borrow limit instead of you risking going all the way to 100% and getting liquidated right away. This is the Apricot assist system right here. You can adjust when it will trigger, and also the target level that you want it to go down, and also the target level you want your borrow limit to go down to. Other features that they have this XFarm feature. So essentially you're farming liquidity pools with leverage. What you're doing is you're depositing money, borrowing out tokens using leverage, and then staking those inside of liquidity pools in order to earn yield on them. I haven't really messed with this much, but it seems pretty interesting. So one of the other things I want to talk about was a lack of liquidity. So one of the problems with Apricot Finance is this in-app swap no longer works for Bitcoin. Let me show you an example let's suppose I want to buy some Bitcoin using my in-app swap. You can see right here, it's giving me a pretty terrible price, right? The price impact is 8.6%, and I'm only getting a price of $19,000. You can see that currently the price of Bitcoin is around like $21,000. So it's not giving me a very good price. And the reason for that is because Apricot is still swapping using Orca's old liquidity pools. So if you go to Orca's old liquidity pools right here, push pools, you can see the total liquidity in here is only $44,000. So that's literally only like one Bitcoin. There's only like one Bitcoin in this whole pool right here. I suppose I try buying a whole Bitcoin, right? The price impact is 48%. So I'm selling Bitcoin for a price of only $10,000, which is half of its current $21,000 price, which is a terrible deal. So what Apricot needs to do is they need to upgrade to using these whirlpools. So Orca recently migrated from using pools to like whirlpools. If you've ever used Uniswap v3, these are like concentrated liquidity pools. And you can see right here, this is the pool you want to trade against. It's got $414,000 in liquidity, which still honestly isn't much liquidity, but it's definitely better than the other pool that we just saw. So when you're making big trades, keep an eye out for the price impact that you're making, and try to avoid making big price impacts, because if you're making a price impact, you're not getting the best price. Now, talking about tokens I like to short, your options are pretty limited here. But of the ones that I have available, I like to short Bitcoin because Bitcoin's just kind of a bubble. It doesn't have a lot of utility. Ethereum probably won't crash as much as Bitcoin will because people actually use it to do things like DeFi and trading NFTs. But I'm still going to short like the entire market. I'm going to short Ethereum and I'm going to short Solana. Even though I believe in Solana, I like Solana long term, I still feel like these cryptocurrency prices are very high. I actually really like Orca. They're actually the best trading platform on Solana right now, which is why I use them rather than Radium. But I don't know how I feel about their token, because these sorts of rewards tokens always end up being like super inflationary. Serum is one of the stupidest tokens I've ever seen. If you look at Serum, it has a circulating market cap of around 274 million, which is huge. And even more ridiculous is its fully diluted market cap. It has a fully diluted market cap of 10.5 billion. So that means that a tiny percentage of the actual Serum tokens in existence are actually being circulated and sold, and the foundation itself is just holding on to a massive amount. So if they ever decided to start selling their holdings, the price of Serum could crash easily from $1 to like a penny pretty quickly. And I don't mean to bash the Serum project itself. Actually, like, they're really great people and they have like a lot of great shit that they're building. I just don't like the token very much because of the low float compared to the total supply that they have. But those will be the ones that I'm shorting. I'm pretty much shorting the entire market for now. But let's suppose that you think that we've already hit a bottom. You think I'm wrong, we've hit a bottom, and the price of a lot of these tokens are just going to shoot up right from here on out, right? Shoot up straight to the moon. So in that case, you can also use this borrowing and lending platform to do a leveraged long. Leverage can be used for more than just shorting. It can also be used for holding a long position. So in this case, I'm going to deposit 0.25 SOL, which is worth about $9.70. Now I'm going to go over to swap, and I'm going to swap from USDC into SOL. It lets me borrow out a maximum of $23. Lets me borrow out a maximum of about $23. Now you can see right here I owe about $23. I have $33 in assets still, so the net amount is still the same at about $10. But you can see that instead of having 0.25 SOL, I now have 0.86 SOL. So I've used leverage. I'm at 2.5 leverage right now. So I've used leverage to do a long position. So now if the price of Solana goes up, let's suppose the price 2x's from here, I'm going to get a 5x return because I'm using 2.5x leverage on my Solana position. You'll also notice that the loan to value ratio is smaller for Solana. So like for USDC, because it's a stable coin, we had 90% we were working with before, but for Sol it's only 80%. So that means I can't get as much leverage using Solana as collateral as I could when I had USDC as collateral. But yeah, that's everything I want to show you guys today. I hope this video was really helpful, and best of luck with your future crypto trading. See you guys. Good luck.